Right after Donald Trump won the 2024 presidential election, fresh data from December showed something interesting. Many countries started pulling back on how much U.S. government debt they held. Out of 20 major economies that usually invest in U.S. Treasury bonds, 16 decided to cut back. Some of the biggest drops came from the United Kingdom, which reduced its holdings by $44.1 billion, Japan by $27.3 billion, and Saudi Arabia by $15.1 billion. Other countries trimmed their investments too, though by smaller amounts: China by $9.6 billion, Switzerland by $9.7 billion, and India by $14.9 billion. So why the sudden pullback? It seems many global investors and central banks were feeling cautious. They were concerned about what Trump's policies might mean for the economy and didn't want to get caught off guard by any surprises. This isn't a new strategy. Countries that invest heavily in U.S. debt keep a close eye on things like trade policies, interest rates, and diplomatic moves. If they sense anything unpredictable or risky, they often scale back to avoid potential losses. One big concern is how much money the U.S. government plans to borrow. If investors think upcoming policies might weaken the dollar or balloon the national debt, they might see U.S. Treasuries as less appealing. When lots of foreign investors sell off these bonds, it can push up interest rates, making it more expensive for the U.S. government to borrow money. This doesn't just hit Washington. It can also mean higher costs for American families and businesses, like pricier mortgage rates or more expensive business loans. And here's the bigger picture. If this trend of selling off U.S. debt continues, it might make people question the strength of the U.S. dollar as the go-to currency for global trade and savings. For decades, the U.S. dollar has been the king of global finance. But when foreign countries start pulling back from U.S. government debt, it raises eyebrows. If this keeps happening, it could signal a slow shift toward other safe haven assets, like euro-backed bonds, different major currencies, or even old-school gold. But this isn't just about numbers on a spreadsheet. The sell-off following Trump's 2024 election win might reflect deeper tensions bubbling under the surface. When trade disagreements flare up or diplomatic ties get strained, big investors from other countries often start moving their money elsewhere, even if they don't make a big fuss about it. The thing is, these changes can happen quietly. A country doesn't need to make a public announcement to make an impact. Slowly but surely, as they cut back on U.S. debt, it can chip away at the dollar's global dominance. And if future policies stir up more uncertainty or spark fresh conflicts, what started as a post-election shuffle could grow into a long-term trend of countries spreading their investments far and wide, away from U.S. markets. Central banks usually stock up on U.S. Treasuries because they're considered super safe, kind of like a financial safety net. But lately, many countries are rethinking that strategy. They're looking to balance their reserves with other currencies or assets, especially gold, to avoid putting all their eggs in one basket. This movement, often called de-dollarization, is about reducing reliance on the U.S. dollar. China, for example, has been quietly trimming its stash of U.S. Treasuries, which dropped to $760.1 billion in October 2024, the lowest it's been since 2009. It's all part of China's bigger plan to diversify and reduce its exposure to the U.S. financial system. One major reason countries want less dependence on the dollar is because of the power it gives the U.S. in global finance. The U.S. can use its influence to impose sanctions, which has made some nations rethink their heavy reliance on dollar-backed assets. This shift isn't just talk. The Unhedged podcast recently highlighted how central banks and sovereign wealth funds are scooping up gold as a shield against potential U.S. sanctions. Countries like Poland, Turkey, India, Azerbaijan, and China have been leading the charge in this gold-buying spree. There's also a more tactical reason for some of these sell-offs: currency control. Nations sometimes sell off U.S. Treasuries to strengthen their own currencies. Japan, for example, reduced its holdings from $1.087 trillion in November 2024 to $1.060 trillion in December, likely as part of efforts to stabilize its currency. Japan's recent move to trim its stash of U.S. dollar assets wasn't random. It was part of a bigger plan to boost its own currency, the yen. By selling off U.S. Treasuries and buying more yen, Japan aimed to strengthen its currency and stabilize its economy. But there's a trade-off. When countries do this, it often means they end up holding fewer US bonds in their reserves. Meanwhile, back in the US, Treasury yields have been climbing. Why? A mix of policy changes, like tariffs and shifts in immigration rules under Trump's administration, has stirred up expectations of stronger economic growth and possibly rising inflation. When inflation goes up, interest rates tend to follow, pushing up the yields on government bonds. But here's the catch. When yields rise, the value of older bonds, those issued at lower rates, drops. This forces investors to rethink their strategies. Adding to the pressure, the Federal Reserve signaled that it might slow down on cutting interest rates in 2025 because of inflation concerns, which only reinforced the upward trend in yields. Zooming out, there's been a bigger, more strategic shift unfolding over the past couple of decades. Since the 9/11 attacks, the US has used its financial system as a tool of influence, leveraging the dollar's global dominance. By controlling access to its banking system and imposing sanctions, the US has been able to apply economic pressure on countries like Iran, North Korea, and Russia. But this power play hasn't gone unnoticed. Countries on the receiving end of these sanctions, and even some allies, have started asking, are we too dependent on the US dollar? This question has fueled the global push toward what's known as de-dollarization, reducing reliance on the greenback. One of the main ways countries are doing this is by trading directly in their local currencies. China and Russia, for example, have been ramping up trade deals using yuan and rubles instead of dollars. India and Iran have also explored similar setups, making it easier to bypass US-controlled financial channels. Another big move has been building alternative banking systems to get around SWIFT, the global messaging network that most banks use, but one that's heavily influenced by Western powers. In response, Russia developed its own system, SPFS, and China rolled out CIPS for cross-border transactions. These systems give countries more control over their international payments and help them dodge potential US sanctions. On top of that, global alliances have been joining the push. The BRICS group, Brazil, Russia, India, China, and South Africa, has been actively discussing creating a new reserve currency that could rival the dollar. Russia, in particular, has been urging its trade partners to switch to alternative currencies, especially after facing waves of Western sanctions. Even the oil market, long dominated by dollar-based deals, is seeing cracks. Countries in the Gulf Cooperation Council, GCC, have started considering accepting payments in other currencies, like the Japanese yen, hinting at big changes in global trade habits. Central banks aren't sitting still either. Many are shaking up their foreign exchange reserves, pulling back from US Treasuries and stocking up on gold, a classic safety net in uncertain times. China, Japan, and India have all been quietly shifting their portfolios, cutting their US bond holdings while boosting investments in other assets. Countries around the world have been making quiet but deliberate moves to shield their economies from the ripple effects of US monetary policies and potential economic pressure. This shift isn't about ditching the dollar overnight, it's about creating more options and reducing over-reliance on a single currency that holds immense global power. The idea of the US dollar losing its top spot as the world's go-to currency might seem far-fetched, at least for now. But bit by bit, nations are finding new ways to gain financial independence. Whether it's trading in local currencies, stockpiling gold, or building alternative banking networks, the push for greater control over national economies is gaining traction. This slow but steady shift depends on a mix of factors: global politics, the strength of new financial systems, and how well countries can work together to sidestep dollar dominance. While the dollar still reigns supreme, cracks are starting to show in the foundation. But this isn't the first time the world has seen a major currency shift. Before the US dollar took the throne, it was the British pound sterling that ruled global finance. The pound's power was closely tied to the British Empire's vast network of colonies and trade routes, making it the top choice for international commerce during the late 19th and early 20th centuries. However, Britain's dominance began to unravel during World War I. The war drained the country's gold reserves and left it drowning in debt. In an attempt to restore stability, Britain tried to bring back the gold standard in 1925, but the effort was short-lived. The Great Depression hit hard, and by 1931, Britain was forced to abandon the gold standard altogether, shaking global confidence in the pound. Meanwhile, across the Atlantic, the United States was on the rise. The creation of the Federal Reserve in 1913 gave the U.S. a strong central banking system, bringing more stability to its economy. Throughout the 1920s and 1930s, New York City grew into a major financial hub, gradually challenging London's dominance. But it wasn't until after World War II that the US dollar truly took center stage. In 1944, global leaders met at the Bretton Woods Conference and agreed on a new financial system. The US, with its massive gold reserves and booming economy, became the anchor of this system. The dollar was pegged to gold, and other currencies were tied to the dollar, creating a stable global exchange network. This setup made the US dollar the world's primary reserve currency, and for a while, it worked. Countries trusted the dollar because they knew it was backed by gold. But by the late 1960s, cracks started to appear. The US was dealing with rising inflation and a growing trade deficit, putting pressure on the dollar's stability. In 1971, something big happened that completely changed how global money worked. President Richard Nixon made a surprise move, later known as the Nixon Shock. He cut the link between the US dollar and gold. Before this, countries could trade their US dollars for gold, but Nixon put an end to that, flipping the script on how the world's money system worked. This bold step ended the Bretton Woods system, which had been in place since 1944. Back then, right after World War II, leaders from 44 Allied countries met in a little town in New Hampshire called Bretton Woods. They had one big goal: avoid another global economic mess like the one that had followed World War I. The solution? Create a stable money system that would keep currencies steady and encourage countries to work together, not against each other. Out of that meeting came two major financial powerhouses: the International Monetary Fund, IMF, designed to keep currencies stable and help countries in financial trouble. The International Bank for Reconstruction and Development, IBRD, now part of the World Bank, it focused on rebuilding war-torn Europe and supporting economic growth worldwide. At the heart of this new system was the US dollar, pegged to gold at a fixed rate. Since the US had the biggest stash of gold after World War II and a booming economy, the world trusted its currency. This trust turned the dollar into the backbone of global finance. Throughout the 1950s and 60s, countries everywhere filled their reserves with US dollars. But by the late 1960s, cracks began to appear. The US was spending more money than it was making, especially with the costs of the Vietnam War, and foreign countries started asking for their gold in exchange for dollars. Faced with a potential economic disaster, Nixon took action. His decision to break the dollar-gold link didn't crash the system as some feared. Instead, it launched a new era of floating exchange rates, where currency values were determined by market forces, not fixed to gold. Even without gold backing it, the US dollar stayed strong. Why? Because the US economy was still one of the biggest and most stable, and the dollar was deeply woven into global trade, especially the oil market, thanks to the petrodollar system, where countries paid for oil in US dollars. Fast forward to the 1990s. After the fall of the Soviet Union, the US became the world's only superpower. This was the golden age of the dollar. Globalization was booming, the US tech industry was taking off, and Wall Street was the place to be. Investors around the world saw US Treasury bonds as the safest bet, and countries kept stacking up dollars in their reserves. Even when the euro was introduced in 1999 as a potential rival, it didn't shake the dollar's dominance. By the early 2000s, nearly 70% of global foreign exchange reserves were held in dollars. But then came 2008, the global financial crisis. It started in the US housing market but quickly spread worldwide, shaking trust in American banks and financial systems. Ironically, even as the US was the source of the crisis, investors rushed to the dollar as a safe haven during the storm. However, the cracks were now clear. Central banks realized they had too many eggs in one basket. After the crisis, many began to diversify their reserves, buying more gold and other currencies to protect themselves from future shocks. Enter China. As its economy skyrocketed, China pushed hard to get its currency, the renminbi, ERMB, more international recognition. It created new financial networks like the Asian Infrastructure Investment Bank, AIIB, to rival Western-led institutions like the World Bank, giving countries an alternative for development funding and reducing reliance on the US dollar. China has been playing a smart game to boost its currency, the renminbi, RMB, on the world stage. One big move, pouring money into massive infrastructure projects through its Belt and Road Initiative, BRI. Think railways in Africa, ports in Europe, and highways in Asia, all funded in many cases using the RMB. This not only gets countries hooked into China's economic network, but also puts its currency into global circulation. But China didn't stop there. To make trading smoother without always having to use US dollars, it set up special deals called currency swap agreements with multiple countries. These deals let countries trade directly in their own currencies and RMB, cutting the dollar out of the equation and making China an even bigger player in global finance. Now let's talk about something that's shaking up money as we know it: blockchain and digital currencies. These technologies are rewriting the rulebook on how money moves across borders. Central banks around the world have noticed and are jumping on board, creating their own central bank digital currencies, CBDCs, to keep up with this fast-paced change. By early 2024, over 130 countries, including the US, were exploring or developing their own digital currencies. But China? It's way ahead with its digital yuan, also called the ECNY. It's not just about making payments faster. It's part of China's bigger plan to make the RMB more popular globally. Meanwhile, in the digital finance world, the US dollar still holds its ground thanks to stablecoins, digital currencies tied to the dollar's value. These are used in international trade and online transactions, keeping the dollar relevant even in the age of crypto. Still, the dollar's grip isn't what it used to be. In 2022, its share of global reserves slipped to around 58%, while other currencies like the euro, the Chinese yuan, and even gold started grabbing a bigger slice of the pie. A major clue to this shift? The falling demand for US Treasuries, especially from China. Back in 2013, China owned a whopping $1.3 trillion in US government bonds. But by the end of 2024, that number had dropped to about $759 billion. Why the big sell-off? It's partly because China used to buy tons of US dollars to keep its own currency, the RMB, stable, and its exports cheap. But as its trade gap with the US narrowed after 2018, there was less need to stockpile dollars. On top of that, Chinese officials started worrying about having too many eggs in the US dollar basket. If something were to shake the US economy, or if tensions between the two countries flared up again, China could take a hit. So they began spreading their investments around, looking for safer and potentially more profitable options. And now, it seems like other countries are catching on and following China's lead, gradually dialing down their reliance on US Treasuries. The shifting global landscape, especially the growing tensions between the US and China, has pushed Beijing to rethink its financial strategies, especially when it comes to how much US debt it holds. For China, cutting back on US Treasuries isn't just about dollars and cents. It's a smart move to reduce risks tied to political friction. By holding less US debt, China lowers its exposure to any economic fallout that could happen if relations with the US take another turn for the worse. But here's an interesting twist. Some people believe that if China were to dump a huge chunk of US debt, it might actually backfire. Instead of hurting the US, it could end up strengthening the dollar while driving up the value of China's own currency, which isn't exactly what Beijing wants. Even though China has been trimming its holdings, the overall US debt market has grown so much that China's slice of the pie has gotten smaller. Back in 2011, China held around 14% of all US Treasuries. Fast forward to 2024, and that number has shrunk to less than 3%, the lowest it's been in over 2 decades. But China isn't the only one making moves. Japan has been tweaking its strategy too. In March 2024, Japan held about $1.17 trillion in US debt, But by December, that number dipped to $1.06 trillion. Even with that drop, Japan still holds the title of the largest foreign holder of US Treasuries. Why the pullback? Japan's been busy trying to keep its currency, the yen, from sliding too far against the dollar. When the yen weakens too much, the Bank of Japan steps in, selling off US Treasuries to buy yen and prop it back up. Plus, Japan's domestic policies, like managing interest rates and battling inflation, play a big role in how it handles its foreign reserves. Meanwhile, over in the United Kingdom, there's been some action too. After Donald Trump's re-election in November 2024, the UK trimmed its US Treasury holdings from about $767 billion to $723 billion. Why the cut? It came down to a mix of politics and market jitters. Trump's plans for big tax cuts and increased government spending had investors on edge, expecting higher inflation and more US government borrowing. That sent Treasury yields soaring. Since bond prices drop when yields go up, the UK's existing holdings lost value, leading them to rethink their strategy and sell off a chunk. This wasn't just a UK thing though. Bond markets around the world felt the heat, with fears of inflation and rising borrowing costs shaking up global finance. And like China, the UK is now more focused on diversifying its reserves, spreading risk by investing in assets like gold and cutting back on US dollar-heavy holdings. The stronger US dollar after Trump's re-election also played a role. As the dollar gained strength, the relative value of foreign-held US assets shifted, nudging countries like the UK to adjust their portfolios. Over in India, there's been a similar pattern. The country scaled back its US Treasury holdings from $240 billion in March 2024 to about $219 billion. The Reserve Bank of India has been fine-tuning its foreign reserves, aiming for more balance and less reliance on US debt. The Reserve Bank of India, RBI, has been busy behind the scenes, stepping in to steady the Indian rupee as it battles global economic ups and downs. Rising US interest rates and investors pulling money out of India haven't helped, putting even more pressure on the currency. To keep things balanced, the RBI has been working hard to stop wild swings in the exchange rate. But India isn't just focused on quick fixes, it's thinking long-term. The country has been reshuffling its foreign reserves, putting more emphasis on gold and other investment options. This way, it's not putting all its eggs in one basket, especially when it comes to assets tied to the US dollar. India's also looking to strengthen its trade links with emerging economies, hoping to build a more stable financial future. Over in the Middle East, Saudi Arabia has been making its own strategic moves. Its US Treasury holdings slid from $142 billion to $137 billion over 6 months. As a major oil exporter, Saudi Arabia's reserves often mirror the rise and fall of global oil prices. With recent dips in oil revenues, it's no surprise the kingdom is adjusting its financial playbook. But there's more to it. Saudi Arabia is thinking beyond oil thanks to its ambitious Vision 2030 plan. The country is pouring money into infrastructure, technology, and green energy, aiming to transform its economy and reduce its dependence on oil. Plus, stronger trade ties with countries like China may be encouraging Saudi Arabia to shift some of its reserves away from US Treasuries. Meanwhile, Germany has also been tweaking its financial strategies. The country trimmed its US Treasury holdings from $104 billion to $97 billion in just half a year. Germany, being the largest economy in the Eurozone, keeps US Treasuries in its reserves to help manage risks and balance its books. But lately, Germany has been thinking greener, literally. The country has been investing more in green bonds and other sustainable assets, part of its broader goal of promoting long-term economic stability. With inflation concerns and changes in the European Central Bank's policies, Germany is carefully adjusting its reserves. Plus, there's a quiet push to give the euro a bigger role as an alternative to the US dollar on the global stage. Norway has been moving pieces on its financial chessboard too. Between August and December 2024, its US Treasury holdings dropped from $166 billion to $157 billion. Most of these holdings are managed through Norway's massive government pension fund Global, one of the world's biggest sovereign wealth funds. Norway likes to spread its investments around, putting money into everything from stocks to bonds and alternative assets. The recent dip in U.S. Treasuries simply reflects a shift toward higher yield investments, especially as global interest rates continue to change. Norway's big picture strategy? Balance risk while keeping its long-term financial goals in sight. But here's where things get even trickier. Tariffs and rising economic tensions are shaking up the game. A wave of new tariffs, 25% on all countries, with extra penalties on key sectors like cars, semiconductors, and pharmaceuticals, has countries rethinking their exposure to U.S. debt. For many nations, cutting back on U.S. Treasuries isn't just a reaction, it's part of a bigger plan to reduce their reliance on the U.S. financial system. By shifting their reserves into other assets, countries can hit back at trade restrictions and safeguard their economies. This global reshuffling is also fueling the broader trend of de-dollarization, where countries are slowly moving away from using the US dollar as the world's go-to currency. The result? A highly unpredictable economic landscape. Tensions between the US and other major economies are stirring up market volatility, shaking global supply chains, and pushing up inflation in some regions. Of course, some argue that these tough trade policies could eventually lead to fairer practices and a more balanced global economy. But the big question remains, will this bring stability or push the world deeper into economic uncertainty? One thing's for sure, the world's financial system is at a crossroads, and what happens next could reshape global trade, shift reserve currencies, and rewrite the rules of international finance. If you found this video interesting, be sure to hit that like button and don't forget to subscribe.